All right, when you hear the name Warren Buffett, what's the first thing that pops into your head? For most of us, it's buy and hold, right? The ultimate patient investor. But what if I told you that's not the full picture? Not even close. The real story of how he built his massive fortune is actually way more fascinating. It's the story of an active, incredibly opportunistic trader, using strategies that have almost nothing to do with just buying a great company and sitting on it forever.
Yeah, we've all heard this one. His famous rules. It's part of that folksy, grandfatherly image, you know? The guy who sips Coca-Cola, buys companies he understands, and just holds them. Forever. That's the Buffett of legend, the Oracle of Omaha, just dropping these simple pearls of wisdom.
And look, that image isn't necessarily wrong, but it's just not the whole story. It's incomplete. That's really the Buffett from his later career, once he was already managing billions and billions of dollars. To really get a handle on his genius, we've got to go back. We have to look at how he made all that money in the first place.
So, let's do that. Let's dive into his early years, back when he was running his first partnerships, kind of like a hedge fund, from about 1957 to 69. And when you look at his track record from back then, a totally different picture emerges. This wasn't a buy and hold guy. This was a sharp, super versatile trader who was always on the hunt for weird little quirks in the market. So yeah, it's time to open up his toolbox.
Okay, tool number one. This one comes straight from his legendary mentor, Benjamin Graham. And it's got this really memorable name, cigar butt investing. This was basically the cornerstone of his whole early deep value strategy.
The whole idea is, it's exactly like the quote says. You're walking down the street and you find a cigar someone tossed out, but there's still one good puff left in it. It's not a great cigar, but hey, it's a free puff. In investing terms, this means finding a totally unloved, forgotten company that's trading for less than it's worth in pieces. I mean, literally, if the company were to shut down today, sell off all its assets, and pay off all its debts, the cash left over for shareholders would be more than what the entire company is selling for on the stock market. It's not a fantastic business for sure, but for that moment, it's a fantastic stock. Why? Because the price is it's just too cheap to ignore.
And this whole way of thinking, it's all built on top of the single most important principle he ever learned, again straight from Ben Graham, margin of safety. The key thing to get here is that it's not about being a genius who's right all the time. No way. It's about building a buffer, a cushion, that's so big that it protects your money from huge losses, even if you get things wrong.
And this is how he turned that abstract idea into something real, something concrete. It wasn't just a gut feeling, it was a literal checklist. Number one, does it sell for less than its liquid assets? Check. Number two, is it in danger of just burning through all that cash? Hopefully not. Check. And number three, has it actually shown it can make money in the past? Check. If you could tick all three of those boxes, boom, you found yourself a genuine investment bargain.
Okay, so Buffett wasn't just digging around for these cheap, beat-up companies. The next tool in his kit was totally different. It was all about finding value in very specific situations. Events that had a clear end date. He called them workouts. Today, you'd probably call it merger arbitrage.
See, with this, he wasn't trying to predict the entire market. He wasn't trying to guess if the S&P 500 was going up or down. Instead, he was focusing on one single thing, analyzing the chances that a publicly announced deal, like one company buying another, would actually go through. He was betting on a timetable, on a specific event, not on the random mood swings of the market.
And this is what's so cool about it. He was basically trading one kind of risk for another. He was swapping the completely unpredictable chaos of market risk, things like interest rates, the economy, what investors are feeling that day, for a much more specific, analyzable set of risks, the deal risk. Can you figure out if regulators will approve it? Yeah, you can research that. Can you look into the financing? For sure. It turns the whole thing into a game of probabilities, not just blind prediction.
So just to show you how completely nuts the market can get and where these opportunities pop up, we got to look at a classic example, the legendary 3Com and Palm situation. This happened right at the absolute peak of the dot-com bubble in March of 2000. It's wild. All right, so here's the deal. There was this parent company, 3Com, and it owned this super hot subsidiary that made those old Palm Pilot organizers, Palm. So 3Com decides to sell off a small piece of Palm to the public in an IPO. It goes gangbusters. And after that IPO, if you looked at the value of the Palm stock that 3Com still owned, plus all the cash 3Com had, it added up to about $152 per share of 3Com stock.
Now, here's where it gets absolutely insane. On that same day, 3Com's own stock, the parent company, was only trading for $81. Just let that sink in. The value of the stuff inside the company was worth almost double what the market was saying the entire company was worth. It makes no sense.
What this meant, and this is the crucial part, is that the market was implying that 3Com's own core business, which was profitable, by the way, was worth less than zero. Think about it. If the Palm shares and cash it held were worth $152, but the stock was trading at 81, the market was basically saying the rest of the company was worth negative $71 per share. This is the exact kind of glaring, mathematically impossible stuff that arbitrageurs live for.
All right, our final tool. This one shows how, as Buffett got bigger and more famous, he started using his reputation and his huge pile of capital as a weapon. He could get into these VIP deals that were totally off limits to you and me, and he could literally engineer his margin of safety right into the deal from day one.
He often did this using something called a PIPE deal, that stands for Private Investment in Public Equity. Basically, when a public company got into trouble and desperately needed cash but couldn't get it from the normal markets, who would they call? Warren Buffett. He'd step in, almost like a private lender, but he'd negotiate these absolutely incredible one-of-a-kind terms just for him.
And this is where you really see the genius at work. In his famous deals with companies like Salomon Brothers or Gillette, he didn't just buy their stock. No. He structured it so Berkshire got special preferred stock that paid a huge, safe dividend, like 9 or 10%. That's his margin of safety right there. He's getting paid to wait. But, and this is the kicker, he also got an option, basically a free lottery ticket, to convert that safe investment into regular common stock later on, so he could share in all the upside if the company turned around and the stock went through the roof. It was the perfect setup. Heads, he wins big. Tails, he still collects his dividend and doesn't lose much. Incredible.
So let's take a step back. We've looked at the cigar butts, right? We've seen the merger arbitrage workouts, and we've just seen these private VIP deals. And on the surface, man, they seem like they have nothing to do with each other, and certainly nothing to do with just buying Coca-Cola stock and holding it for 30 years.
But here's the thing. They are all connected. There's one powerful, unifying idea that ties all of them together. You see, Buffett wasn't obsessed with any single strategy. He was obsessed with a single goal, finding a massive margin of safety, no matter what it looked like. It could be buying assets for 50 cents on the dollar. It could be betting on a deal that had a 95% chance of closing. Or it could be negotiating a deal where he got a huge, safe dividend. The goal was always the same. Protect the downside first.
And that brings us right back to the core lesson from his mentor, Ben Graham. This is the key to all of it. The actual strategy doesn't matter as much as you think. It can be short-term, long-term, public stocks, private deals. It's all on the table as long as it meets this one strict definition of what an investment truly is. If it doesn't promise safety of your principal and a decent return, then in Graham's world, it's not investing. It's just gambling. It's speculation.
So why does any of this matter? Who cares about this other side of Warren Buffett? Well, it matters because it shows that his real genius wasn't just one simple tactic like buy and hold. It was his relentless, unwavering focus on one single principle, margin of safety. And that's the real challenge for all of us. It pushes us to look past the easy headlines, past the popular stories, and to actually do the work and analyze things for ourselves. It forces us to ask that really powerful question, where is that exceptional value hiding in plain sight today? Thanks for watching this explainer.